And so everybody's looking for that indication that the economy is cooling. The leading indicator for this is jobs. So we had a really hot ADP jobs report this morning, right? Over 450,000 new jobs created, and everybody got nervous. The 10-year shot up to over 4%. The market turned down at the start of the day. And then we got the JOLTS report. Now, Larry Summers has described JOLTS as a much more, that's job openings, okay? So this is more of a leading indicator, like how many of the job openings are we consuming? And that actually came in better than expected. So what it suggested is that more people took jobs than we had anticipated. And remember, JOLTS peaked closer to 12 million, and now we're at about 9.8 million. And so when I look at that, and then look at the jobs report, ADP jobs report, over half of the new jobs created were in hospitality and leisure. So think about what was happening a year ago. Airlines were trying to hire people, restaurants were trying to hire people, hotels were trying to hire people, and nobody took the job for two reasons. Number one, they were afraid of COVID, but number two, they were getting stimmy checks from the government. They didn't need to work. Now what we see is people are starting to take jobs. Those show up as higher employment numbers in ADP, but in lower JOLTS, right? So fewer job openings. To me, again, that probably speaks to a healthy trend in the economy. But clearly, the economy is not crashing. We had a lot of people who said that the economy was going to hit the skids in Q1 or Q2 of this year due to these higher rates. The economy is incredibly resilient. But if I had to describe the rate trajectory, the Fed has said, listen, we may have two more rate hikes. That's basically priced in. And if you look at real rates, so this is the interest rate that really acts as the brake on the economy. So this is effectively the 10-year versus future expected inflation. It's now at one of the highest levels we've had since 2008, 2009, back closing in on 2%. So, it seems to me that the Fed's got its foot pretty strong on the brake. It's jawboning the economy, saying we'll do more if we have to. But the things that they're looking at, job openings are coming down, inflation is coming down. So I don't know. I think you have to leave open the possibility that the fat part of the distribution curve looks like a softer landing than most people want to admit.
Yeah, so Chamath, Gerstner is predicting a soft landing. Do you agree? I mean, you've said we're going to see rates stay high for a very long period of time.
Yeah, I mean, I think I've said this for the last few weeks, so I'll just say it again. But I think that it's there's no hard landing, right? That's the hard landing was sort of the Druckenmiller thing that I think that I said. I think it was a few weeks ago. It's very difficult to see a hard landing when China stimulates, just because of their natural gravitational pull in the world economy, and we can talk about that again because it just looks like China's in super, super, super trouble. Meanwhile, I sent this little image to you, and Friedberg, you may just want to throw it up here just to look at. But, when you look at inflation, we've done the best job of the developed nations in getting this thing under control. And so I think now it's just about making sure that we adequately contract the money supply and making sure that we have bullets in the chamber in case things get bad. What do I mean? When you look at this chart, the thing that I think about is I'm glad rates are almost at 6%. Why? Because when you look at the UK, Italy, Germany, most of the Euro area, France, Japan, and then, China, it's non-existent, but China has a different issue. The reality is that, a pretty bad set of economic circumstances could actually touch the Western developed nations if you start to see some of these countries rip rates higher to like 7, 8, 9%. The UK, it seems like, I don't know what you guys think, it's definitely going to 7. And it could go to 8. I mean, it could be a very bad situation for the UK. They're in a lot of trouble. And so I think it's important that the Federal Reserve have tools. So by continuing to constrict the money supply, have rates that are relatively elevated, maybe a quarter or two longer than they need to, it gives them a lot of positive optionality if they need to step in if something bad really happens. And so I generally think they've done a very good job. I think, go ahead.
Chamath, not to interrupt, to your point, what's really interesting is the symmetry with what happened in 2000. So I think we had all agreed that the last time we saw the zaniness that we saw in 2021 in the ZIRP environment was probably like 1999, 2000 era. Well, in 2000, remember, we had this huge asset bubble, and the Fed raised rates from 5.5% to 6% in 2000, okay, in the first half of 2000. And they were saying that they're going to stay high for long. And remember, in 2001, we entered a recession, and we ended 2001 with rates all the way down at 1.75%. Those are the bullets in the chamber that you're talking about. That then pulled us out of the recession. And some people blame them that they caused that recession. But, when you look back from
No, in this case, it looks like,
perspective,
in this case, it looks like the recession is really not of our making, but, we may actually have a soft landing, but the economy could actually contract because when you look at these Western economies turning over, it's not a good situation. I think the Eurozone, quite honestly, is probably a quarter into a recession already. So, we have 6 or 7 of the really important countries probably in a recession. The UK in really big trouble. The US relatively keeping things, in a pretty good place. China economically, I don't know where the demand is going to come from. On the same time that their internal demand is imploding, they're creating all these export controls that I think are not going to actually help them solve the problem because it just accelerates Western economies' desire to delever from China. So the whole setup, I think, is very complicated one, but the U.S. looks really good, frankly. And,
well, yeah, look, I don't think we're out of the woods quite yet. So Druckenmiller, by the way, said that he was predicting a hard landing in the second half of the year. We're just starting the second half of the year. So he's still got 6 months to be proven correct. I find his analysis compelling, or I did at the time I heard it. But think about our situation. We still have an inverted yield curve. It's the most inverted it's been. I think this is the longest it's been inverted. Now the Fed is signaling that we're going to get 2 or 3 more quarter point rate hikes. So it's about to become even more inverted. And what that does is it puts incredible pressure on the banking system because the whole banking business model is to borrow short, which is from depositors, and lend long. And if short rates are higher than long rates, that whole business model doesn't work. So either they can't engage in lending activities, meaning there's a credit crunch, or deposits just leave the system. And that's happening too. So any business out there that's dependent on credit, the real estate industry or auto industry, I mean, any industry that depends on loans and credit, they're going to continue to be hammered by this. So
yeah, I mean, to your point,
Go ahead.
Sachs, I'll just read the minute commentary on this. The meeting did include a discussion on the stress on the banking sector and economic activity in general because of decreased lending. Participants generally noted that banking stresses had receded and conditions in the banking sector were much improved since March. Participants generally continue to judge that a tightening in credit conditions spurred by banking sector stress earlier in the year would likely weigh further on economic activity, but the extent remained uncertain. So obviously a wait and see. And that they mentioned that credit conditions had not appeared to have tightened significantly beyond what would be expected in response to the monetary policy actions taken since early last year. So at this point, saying it's a wait and see does not seem to have overstretched in terms of credit tightening at this stage, but it could.
Yeah, I mean, so here's the thing is that the Fed engaged in an extraordinary intervention a few months ago to save the banking system with the Bank Term Funding Program, right? Where they basically said to all the banks that if you have US Treasuries, and I think it also applied to mortgage-backed securities as well, we will basically take all of those assets and give you par value. We'll give you 100 cents on the dollar.
Yeah.
In exchange for, I guess you have to pay, the bank would have to pay the 1 year, I think it was the 12-month interest rate with like 10 basis points or something like that. So if you're sitting on bonds that have gone down 20 or 30% in value, you can go get all that money back by, presenting them to the Fed.
Mm-hmm.
And then you just have to, you have to then take the 100 cents on the dollar you get and make sure you loan it out at higher than the 1 year interest rate, which is around, I guess, 5%.
Right.
Which you can still do in residential, right? Because mortgages are still something like they're over 7%. So the Fed has provided a lot of liquidity to the banks through this BTFP.